welcome to Adventures in Life. I'm your host, Earl Beecher. You know, one of the advantages of being a college professor is you get to see your students grow and go out and make their mark in society. And I'm very proud of one of my students in particular. He was my grad assistant one year. His name is Bob Daly, and he is an attorney and CPA in Rancho Palos Verdes, or Palos Verdes, California. Bob went on to work with the IRS and became their senior appeals officer, so he's very good in all these fields. And in conversation with him one day, the subject of bankruptcy came up. And I said, Bob, is that pretty widespread? And he said, more than you'd think. And he referred me to a good friend of his who is a bankruptcy attorney specialist, and he's our guest today. Our guest is Dennis McGoldrick, who is an attorney in Torrance, California. Dennis, thank you for joining us today in Adventures in Life.
Thank you for having me.
Dennis, I wanted to ask you, how widespread is bankruptcy occurring in our society here in California, especially since we've had this recession that's gone on for about 5 years?
The bankruptcy numbers are way up in California. The Central District of California, which is the district that goes from Santa Barbara down to the south part of Orange County and over to Riverside, is called the bankruptcy capital of the world. We have about 1 million bankruptcies a year in the Central District.
1 million a year?
1 million.
In about 5 or 6 counties?
Well, maybe I'm talking about the whole country, 1 million a year. But we have the largest number in the country.
We're the bankruptcy capital of the world.
Bankruptcy capital.
Now, when we talk about bankruptcy, we immediately think about, oh, if a person declares bankruptcy, somebody comes in and takes everything they own, and they're down on 5th and Main and homeless and out in the street. Is it all that bad?
Generally not. You
That's reassuring.
you have the right under bankruptcy law to exempt certain property. And California has done an odd thing. It's opted out of the federal bankruptcy system on the exemption side, but it has its own sets of exemptions. There's 2 different sets of exemptions in the state of California. You can take the regular exemptions, which is the one that O.J. Simpson's fighting about, or they have an alternative bankruptcy set of exemptions, which is more like the federal bankruptcy exemptions. So you're entitled to keep some property.
Vaguest what you're talking about. What are the California and what are the federal, and what's the difference?
Well, in California, we have a very nice, handsome homestead exemption. Individual people get to claim a $50,000 equity in their house as exempt. Married people, $75,000, and people over 65 or disabled, $100,000. That's in the California system.
What do you mean homestead?
A homestead is an exemption that you get to claim on your house where you live.
Yes.
That cannot be taken from you except by a voluntary lien holder. If you go get a mortgage on your house and the first trustee holder that has the mortgage on your house forecloses, they can take your house. But if you have a first trustee on your house and you have, say, $50,000 equity in your house after the first trustee, and you get sued by anyone, they cannot take your house because your house can be homesteaded for that $50,000 of equity.
Now, homesteading is a deliberate action you have to take, like go file forms for it or something, isn't it?
No, not in the state of California any longer. And,
is it automatic? Does everybody have it?
There's an automatic homestead in the state of California, yes.
Oh, I didn't know that. I thought, you know, when I think of homestead, it's like when the pioneers came and they homesteaded the land.
Well, that's the way it was until about 1986, but the Enforcement of Judgments Act, and I can't remember if it was 1984 or 1986, they changed that, and you now have an automatic homestead exemption in the state of California.
And that means the creditors cannot force you out of your house unless you own it free and clear. Then you're in trouble.
You might be in trouble if you own it free and clear. That's correct.
I see.
They have to go into court. A judge has a valuation hearing, and they determine whether they can sell your house for a dollar amount over the homestead, at least before 1986. Now they set your house for sale if the house cannot be sold for an amount that will give you your homestead in full, plus some money for the creditor. They just can't complete the sale. So you don't see a lot of homesteads being sold.
You do not.
Not by judgment creditors.
Now,
no.
This is the California. How does that differ from the federal?
The federal exemptions don't have a big homestead. The federal homestead is only $15,000. But the federal homestead also allows you to use that $15,000 to cover something else if you don't have a house. So you might claim a car exemption.
So if you're a renter, it's different.
That's correct. If you're a renter, and let's say you had a $5,000 car and it was exempt for $2,000, if you don't have a house to claim the homestead exemption, you can use the $15,000 exemption to cover the car and make sure that no one can take the car from you.
And protects your car.
In bankruptcy only.
Okay. So there are certain exemptions that you have. Then what's the next thing that you look at?
Well, the main thing that you want to be able to do for a client that comes in to file bankruptcy is be able to exempt all of their property. If you cannot exempt all of their property, you might advise them not to file bankruptcy, to do some kind of a workout with their creditors or make other arrangements. If you can exempt all of their property, then you take a look at their budget and the amount of money that they make and just see whether or not bankruptcy is really something that they should do. If parties that go to consumer counselors, any kind of a credit counselor, are normally told that you shouldn't have more than 20% of your gross income per year in unsecured debt. So if you make $60,000 a year, you should not have more than $12,000 in credit cards. Now,
Oh, everybody's up to here in credit cards.
yeah, the credit cards are a big problem since the 1970s. I still
Yes.
want to meet the guy that figured out that if you charge 10% over normal credit limits, that you can just send all the credit cards all over the place. So that guy sent me a lot of business.
He did.
Yes, he did.
Well, I will confess to this. Back in 1960, when I was a graduate student teaching at UCLA, we came up with a special seminar for a new textbook where we spent 2 weeks at the Miramar Hotel with the people, and one of the students there was the man who originated the Bank AmeriCard.
Really? That might be him.
His name is Herb Speth. He was a very good man, but this was when the very beginnings of it.
That's correct.
We're getting going.
Yeah, Bank AmeriCard sent out 5 million unsolicited cards, and then a master
And then they
master
had
charge
big
was at the
problems
time.
that came back later.
Did the same, and that started the credit card boom.
Now, a person comes in and you sit down and advise them, yes, you should or you should not.
Correct.
Now, there are different chapters, aren't there?
Yes, there are.
What is the difference?
Well, it depends on what you're trying to accomplish. If you're just trying to wash away your debt so you can start over, then you go through a Chapter 7, which is a liquidation. In a Chapter 7, it's called a liquidation, but in fact, if you can exempt all your property, nothing gets liquidated. You go in, present all your property, claim all your exemptions, and then get a discharge. But if you, for example, are behind on your house payment, $8,000 or $10,000, and you don't have that money to cure the default on your house, you might opt to go into a reorganization proceeding like a Chapter 13, which is called a wage earner reorganization. In a wage earner reorganization, you can cure that $8,000 or $10,000 default in your house over 36 months, as long as you can make the other regular
In other
monthly
words, you make
payments.
the regular payment plus a little catch-up on what you're behind.
Correct.
I see, on a monthly basis.
On a monthly basis.
And
if you
this
can
is
cure
over how many months?
36 to 60 months.
Well,
Generally, they're 36 months.
So the payments are small on the catch-up then,
Well,
pretty much.
if you're 10,000 behind, you're going to pay $400 extra a month. If you have a $1,200 a month
okay.
payment, it bumps it up to $1,600. It can be steep.
Oh, I see. Do the usury laws come in and prevent anything anymore? I know it used to be that if the creditor tried to collect more than a certain percentage, it was considered usury and the debt would be set aside.
There are many exemptions to the usury laws these days, and
I know
credit
all the
cards
financial institutions, namely.
credit cards are exempt. So
Are they?
They can charge you, 18, 19, 20% and get away with it. Yes.
Oh, they compound it way over that. I figured those out.
And the IRS is exempt too.
Yeah, Bob will appreciate that. All right, stay with us. We're going to pause for a public service announcement, but we'll be right back with Dennis McGoldrick. Our guest is Dennis McGoldrick, a bankruptcy attorney from Torrance, California. Dennis, what are some of the other exemptions that a person might have if they declare bankruptcy?
Well, under the regular state exemptions, you're entitled to personal property that's reasonably necessary for your existence. So you're entitled to your clothes, you're entitled to reasonable number of art objects, but nothing like a Picasso or a Renoir. You're entitled to your general goods around the house, your pots and pans and those kinds of things, a refrigerator, all the things you need to fill a house.
So you're not really thrown out penniless into the street?
They don't have the empty barrels any longer, no.
I see. You know, I've been watching how some of the financial institutions work, and you have, say you get into debt, you have a certain amount of debt, and then they start charging the over-the-limit fees, and then the interest on the over-the-limit fees as well as the debt, and then the interest on the interest, and compounding it. You sometimes get the feeling that creditors are trying to push you into bankruptcy. I don't know if any of my viewers have that feeling or not, but how do you get out from under the pressure?
Well, the main thing is to keep a thumb on the amount of credit on the throttle. You just don't want to have more than 20% of your yearly gross in unsecured debt. If you keep below that limit, you should be able to make it. But I see so many people that are at 80%, 100%, 150% of their yearly income in credit card debt. Those people cannot possibly make it.
It really sort of sneaks up on a person, doesn't it, if they use one credit card to pay off another?
Well, that's one of the problems, yes. The credit card companies, see, once the credit card companies figured out that they could lower the criteria necessary to issue credit. It used to be they wouldn't give you a credit card if you had available credit of 20% of your yearly gross. Now you can get $25,000 credit cards in the mail, even if you only make $40,000, $50,000. So the banks stopped using their own throttle mechanism to keep your credit limit down, and now it's just very easy for you to run your credit too high. You personally have to have your thumb on the throttle and make sure you don't go over 20%.
Now, you mentioned a Chapter 7 and a Chapter 13. There's a Chapter 11, too. Isn't there a form of bankruptcy?
Yes, that's correct. Chapter 11 is called business reorganization, but it's been all the way to the Supreme Court now. Individuals can file Chapter 11. It's for people that have a lot of debt. You would want to have more than $1 million worth of debt to do a Chapter 11.
More than $1 million?
More than $1 million.
Well, not too many of us have that.
Well, there are quite a few, but not too many, yeah.
Unsecured?
Some unsecured, yes.
Really?
Yes.
On an income of?
Any number of incomes. People that have businesses often sign guarantees for numbers in excess of $1 million. So. And they don't always
That's another red flag, isn't it? Signing guarantees for somebody else where you don't have any control.
You don't want to do that. A couple of things that people do that are a little bit crazy in my view is don't own a car with someone else. The person who owns a car is responsible for the damages in a wreck. And you may have insurance and you may think you're covered, but if you hit a brain surgeon and break his hand and he's out of work for a year, he's going to sue you for $1 million. And most people don't have $1 million of insurance.
No.
So that kind of a case, those people will be in my office.
They'll be in your office in a hurry, huh?
Just don't own a car with someone else. Make someone else own their own car. Don't put someone else on title on your house. If they have to go bankrupt, you could lose your house. Just too many problems like that.
I see. Are these the ones that you run into most often?
Most often, the very frequent one today is just 80 to 150% of your yearly gross in credit card debt.
Credit cards.
Credit card debt.
It comes back to credit cards most of the time.
If they hadn't changed the criteria for giving the credit cards, we wouldn't have the bankruptcy rate we have now.
You once said that you had handled something like 10,000 bankruptcy cases?
Well, I was a bankruptcy trustee from 1986 to 1991, and I had.
What is a bankruptcy trustee?
A bankruptcy trustee is the person who actually takes a look at the person who's filing bankruptcy and decides whether or not they're going to take any property from that person or just let them go through the bankruptcy and get a discharge. When you file bankruptcy, you file a whole lot of papers, your petition, and what they call schedules. The schedules include a list of assets, a list of debts, a list of your budget, statements of different...
It gives a pretty good financial picture of what you were doing. Okay.
So the trustee has to read all those documents and then determine whether or not he wants to take any property from the party that filed bankruptcy, or even refer them to the United States trustee to have the case declared an abuse.
An abuse?
An abuse.
What's that?
Well, my favorite abuse case was came out of Minnesota, a news anchor that made $600,000 a year, tried to file bankruptcy on $200,000 worth of unsecured debt, and the judge in Minnesota said, get rid of the boat, the car, the cabin, the other toys, and pay your creditors, and threw him right out of bankruptcy. That was affirmed by the 8th Circuit Court of Appeals.
So abuse is when you really do have the capability of paying it, and you're using bankruptcy as an excuse to get out from under doing that?
Correct. Or the other way around, too. There was a group of people in Orange County, maybe 2 years ago, that applied for credit cards, used a particular trick that I don't want to put on the air to get the credit limits raised, and then went out and charged
You don't encourage anybody to do this.
Charged all the goods and took them and sold them. And declared bankruptcy. So they had cash and went bankrupt, and it was kind of a crime ring. So those are also abuses.
I see, where the creditors are really being abused.
Correct.
The trustee, if he does take property, how is it disposed of?
Well, the trustee has to go to court and ask the judge for authority to sell property. He files an application to sell. The judge approves the order. If it's a house or any other property, he has to hire a real estate broker. But a trustee has a lot of jobs to do, because the estate is an actual entity that has to file tax returns and really has its own existence. So if a trustee takes property from someone, the trustee has to be ready to hire a lawyer, hire an accountant, sell the goods, prepare distribution reports for the court, make a distribution report that's approved. It's called a final report. And then sign all the checks and send it out to all the creditors.
Well, you know, this is one of the things that I pictured. I don't know whether I heard it or that. Say a person declares bankruptcy, somebody takes all of their property and sells it off for practically nothing, and doesn't do much satisfying of the creditors anyway.
Well, that's always one of the problems with bankruptcy, but it's kind of built into the system, and I don't think you can blame the trustees. Used goods do not sell for anywhere near what new goods sell for. As a result, a bankruptcy trustee that takes used property and sells it is never going to get enough to make a huge distribution to the creditors that sold the property.
And have anything left over for the bankrupt.
Correct. No, the bankrupt keeps his exempt property, so generally there's not money left over for the bankrupt.
It's not intended even.
No. If a client comes to me that has enough money to pay his creditors, I'll recommend that he sell some property and pay his creditors rather than file bankruptcy. So it's pretty rare that someone comes in with enough assets to be sold to pay all the creditors and get a distribution in the end from the trustee.
In other words, you would recommend to them, don't declare bankruptcy, take care of your affairs and do it right.
That's correct. There's no reason to have that black mark on your credit report.
How bad is the effect of the black mark?
Well, it used to be a lot worse than it is now. A person doesn't get credit unless they build their credit. So if you don't do anything about the black mark, it'll just stay there. California civil law allows the bankruptcy report to be listed on your credit report for 14 years. Mm-hmm. Most credit reporting agencies leave it on for 10. But you can't borrow money without without filling out an application for a loan, and on the application for a loan there's always a little
Have you
box.
ever declared bankruptcy?
Have you ever declared bankruptcy? So if you mark it no, and you have, that's fraud. So that will make that debt non-dischargeable in a later bankruptcy. So,
and if you mark it yes, chances are you don't get the new credit.
Then you're going to have to pay a higher interest rate or something else, right?
So there is a penalty that comes along with it as a result.
That's correct. That's another reason why a young person who's going to be in business later, and I have a feeling they're going to try to run a business, I'll encourage them not to file bankruptcy, because it could cost them more money in the long run, that extra 1 or 2 points on all their business loans for the rest of their life, mm-hmm. than they'll ever save in the initial bankruptcy.
I see.
But you can, I mean, the average person that files bankruptcy can reestablish their credit. It normally takes about 2 years. But you can go get secured credit cards. If you have a house, you're going to make your house payments on time for 2 years. If you reaffirm a lease on a car or anything like that, all those things will be reported on your credit report as current payments, and after about 2 years you can rebuild your credit.
Reaffirm? You used the word reaffirm the credit on your car. What?
You don't have to, reaffirm is a term of art in bankruptcy. It means make an agreement with the lender that you will pay the debt, that you reaffirm you'll pay the debt.
You're accepting that debt and not making it part of the bankruptcy relief.
That's correct.
Okay, they tell me it's time for another public service announcement, so stay with us. We'll be right back. Our guest is Dennis McGoldrick from Torrance, California, a bankruptcy attorney. Dennis, some assets go to the trustee and they're disposed of, but some of them the creditor reclaims. What's the difference?
Well, the difference is creditors cannot reclaim goods unless they have a lien, and a lien has to be perfected. If you sign a normal note, you don't give anyone a lien, but you give creditors liens when you buy a car. You give a creditor a lien when you get a loan for your house. You give a creditor a lien when you use their money to purchase their goods.
How about like Sears, Roebuck, Montgomery Ward, and Robinsons? And
if you use a Sears card at Sears, you're using Sears money to purchase their goods.
So there would be a lien from Sears, Roebuck.
They'll keep a lien on their credit card. Now there's some courts that say that that lien's not that good, but most of the bankruptcy courts...
If I used a Bank AmeriCard or a MasterCard or something at Sears, then they don't have a lien. But if I use a Sears card at Sears...
Sears card at Sears, they have a lien. MasterCard at Sears, no lien.
Oh, okay, interesting.
Very interesting.
Little technical things here.
And Sears won't assert a lien on a T-shirt that you buy there, but they will assert a lien on a Kenmore washer. So.
Okay. Now, you mentioned taxes. Is there any way a person doesn't have to pay their taxes?
Well, income taxes are dischargeable 3 years after they're first due if you filed your return on time. 2 years after they're first due, 3 years after they're first due, if you file their return late, you have to add 2 years from the time that they filed the lien. And there's rules that go on and on and on.
It sounds technical.
I have sheets that we go over with every single person that comes in that has tax problems for every single year and every single tax. So you have to go over every federal tax, every state tax for every year and determine if they're dischargeable or non-dischargeable. But
so if a person is behind in their taxes, that's a whole different ballgame.
That's correct. A person who's audited for years ago comes in with a new audit. 240 days after the audit, the tax is dischargeable. So I get a lot of those.
You get a lot of those?
Mm-hmm.
I see. This is a fascinating subject, and I'm sure there are a lot of our viewers out there who would like to have a chance to call up and say, Mr. McGoldrick, what about this? You could give them a little guidance on that in any event. We want to thank you for being our guest on Adventures in Life today. I think that you've touched a subject that is certainly current with a lot of people if we're the bankruptcy capital of the world here.
Capital of the world.
And so thank you. And thank you for joining us today. And please join us soon again for more Adventures in Life.